I'm super excited for today's event. We have one of the most glorious speakers I can think of, Marc Goldfried, CIO, Chief Investment Officer of Canoe Financial Inc. He's also the head of fixed income there as well. It's not every day we get to have somebody like Marc on the line. So again, Q&A right there in the corner. Press on it. Ask as many questions as you want. We encourage it, and no question is a bad question, right? We're trying to be as layman in our speaking terms as possible. Want to just tell everyone, so welcome back again. Patel Wealth Management here. Our business was started in 1981 by my father, Sheikh Patel. We've actually gone from that traditional stock brokerage business to this more wealth management approach. So anything with a dollar sign we tend to do for our clients. We try to be advisors in that regard. My name's Sheehan, as you all know, and I'm the associate investment advisor on the team. And my job is more or less to facilitate all of the different moving parts so that we can take care of all of the questions that you guys have and concerns and make the proper recommendations. This video will go on YouTube afterwards, so if you aren't able to make it today, we will have it up there. So without a further ado, you have probably the best day to talk to all of our clients and prospects, I guess. I mean, the election happened last night, and who knew that the outcome would have happened? So let's just, I'll let you introduce yourself, and then we'll jump into some questions here, Marc.
Yeah, sure. Thanks, Sheehan. And look, before I even get started in talking about me, I just want to thank the Patel Wealth Management Group for giving me this opportunity. And what I can say to the investors that are on the line and the clients of your particular organization is that the value of advice is very, very strong within this group. We've been in front of these guys for a number of years. They do unbelievably strong due diligence. They care about their clients. Their ability to pull a guy like me because of the good business that they do, to be able to talk to clients directly, says a lot about the organization and says a lot about the advisory services that you're getting. And it's something that I truly believe in. And I'm not saying this because they're paying me. They certainly aren't. I'm saying this because I cover thousands and thousands of advisory groups in Canada, and I don't see this kind of effort in every one of them. There's some great advisors out there. These are those kinds of guys now. You're welcome. Guys, I'm going to say this. I've got this great job. I love this job. I think my blessings every day that I was fortunate enough to be in the right place at the right time, have the educational experience and create a career. But I am a human being. I put my shoes on the same way you do, my pants on. I look at a ton of research. We do a lot of analysis to try to come up with answers, but there's nothing special about what I'm bringing to you except my own knowledge and experience. And because of that, I don't want anyone on the phone or on the live event to feel intimidated about asking a question, as Sheehan had said earlier. I will try my hardest not to use jargon and incredibly technical terms, but sometimes they're going to fall out of my mouth. And when it comes to your money, and this is important, no question's dumb. Every question is important to creating confidence in an outcome that you're looking to get. And if you have a question that you want to ask, please do. And I can guarantee you there's someone else on the call that's got the same question. So
I totally agree.
Yeah. So Sheehan, why don't you start off with sort of some questions? And hopefully
so you know what? It was the election last night. I thought, we would know kind of an outcome. It looks like we've got about 6 states that are completely, it's going to take some time. Why don't we just, I'm going to have to change my questions, I think, on the fly here a little bit.
That's all
right. So I guess we've got these 6 states left. Let's talk a little bit about that, how long that's going to take to get the answers there. And then what are we looking like based on what we're seeing right now? What can we expect based on historical?
Okay, so this is what I'd say to you guys. There's 3 things being contested. The House of Representatives, or what we call Congress, or the lower house. The Senate, so those are the senators, also have legislative ability in the United States, and then the election for the president. So let's just focus on the presidential election right now. And you're right, there's a very, very tight race, based on projections today. Based on projections right now, I shouldn't say today, Biden does have a slight lead over Trump, and it's coming down to these 6 or 7 very key states where where the results are tight and there's still a fair amount of counting that has to happen. So I'll just go through them quickly. The ones that you guys should really be focusing on are Pennsylvania. We believe that we're going to see result no later than today. Right now, I believe Trump is winning Pennsylvania, but it looks like a fair amount of mailed-in ballots from the Philadelphia area, which tend to be very Democrat heavy, is providing some hope. I shouldn't say hope. I don't know how you guys lean one way or the other, but some hope for Democrats that Biden can win Pennsylvania. Wisconsin looks like it's going to go by the way of the Democrats as the votes keep coming in, but we may not have a final result in Wisconsin by the end of the day. Michigan says they'll count by the end of the day. Again, it's a similar story in Pennsylvania where they're counting mailed-in ballots, which are predominantly Democrats. So expectation is that Biden might be able to improve and win that. Georgia, a little tougher, very tight race, traditionally Republican and likely will stay Republican. Arizona is probably going to flip to the Democrats, and we should see results on both Georgia and Arizona hopefully today. North Carolina, very, very tight race, and it can take up to 9 days, according to their legal or their legislature, to declare where they're going to put their electoral votes. And lastly, Nevada, which can take also a few days and have slowed down their counting, and we'll be repicking it up this morning. So we still have a lot on the table here. And what I would say, and guys, I'm not a political expert, but I've been watching as much as everybody else. Biden has more paths to victory today, to the presidency, than Trump does. Having said that, we know that these elections are not well predicted by the incoming polls. We saw a whole lot of polling prior to the election suggesting there would be a full Democratic sweep, which created some outcomes in markets, expectation of great fiscal stimulus, expectation of future inflation, all these kinds of things. And now we have to rethink our way through all of these, because really I think one of the key things that we can say right now is that the Democrats are likely going to retain Congress or the House of Representatives, and it looks fairly certain that the Republicans are going to retain the Senate. In that case, whether it's Biden or Trump in the presidency, we are going to have morass in terms of legislative ability as we go through, because again, bipartisan politics are going to pick up. So there are outcomes for both of these, and I'm happy to go through those, but based on sort of your questioning, so I just don't go down the wrong road. By the way, guys, I love the sound of my own voice, and I will talk all day. So cut me off at the appropriate points.
Yeah, the first time I actually met Mark, I think he talked to us in our office for 2 hours, and then he didn't even tell us to invest in his own fund. Funny enough, it's the weirdest thing. But he did.
That's secondary.
You did touch on fiscal stimulus.
Yeah.
Fiscal stimulus, monetary policy. What are the two things, so people actually know on the line, as well as you did talk about who's winning. I know it's a close call right now, 238 to 213, and these are electoral votes. Maybe you want to expand on that. Yeah,
so look, again, not going to be the world's expert on the U.S. political system, but the way I understand it works is that you vote inside your state. Your state has a certain number of electoral votes. Based on the results within that state, there are people that actually go and vote those electoral votes. So, one thing that we absolutely haven't touched on, which is a real item here today, is the statement that President Trump, and I'm going to get back to your other questions.
Yeah, for sure.
The statement President Trump made in the middle of the night that, look, this election's over and I've won. If we go over the next couple of days and all of a sudden it turns out that the Electoral College votes go in the favor of Biden, a contestation of the U.S. election is likely in the offing. That's not going to be good for markets. Markets do not like uncertainty. Having said that, right now, what I would say is the way the market's reacting is pretty simple. That with a split, not a sweep, that the likelihood of the Democrats rolling back tax decreases, corporate tax decreases, has gone down substantially. I think that's helping the stock market. And the bond market, of all things, is rallying at the same time. This is a very unusual situation. Generally speaking, the bond market goes up and the stock market goes down, and vice versa. And the reason the bond market likes this is over the last few weeks, with the concept of a Biden sweep and monstrous amounts of fiscal stimulus expected, which would create economic growth and the potential for future inflation, interest rates were backing up. Now, in the absence of that, and likely what's going to be a much more modest package on fiscal stimulus, if we get a blue, red, blue kind of construct, the bond market is now taking out all that excess yield that it put back into the bond market for the potential for future inflation. So your original question was fiscal and monetary policy. Okay, so first off, fiscal policy is what's legislated by the government. That's infrastructure programs, checks that go, like the checks that went out to everybody in Canada, for example. That's how we pay police. It's how we, fund hospitals and education. And, the fiscal stimulus programs need to be legislated. Right now, you guys saw for the last month and a half, Secretary Treasury Mnuchin and Speaker of the House Pelosi were arguing back and forth about a potential for fiscal stimulus, couldn't get anything done. And we're still kind of in that situation. So fiscal stimulus will be greatly impacted by the election outcome, whereas monetary policy less so, and I'll get into that in a second. So had we got a Biden sweep, I think the expectation would be very easy to legislate a large fiscal stimulus package in an effort to combat the economic degradation and fundamental change that we've seen in the economy since COVID-19. Okay. Now that you have the Republicans in the Senate and, absent, Democratic president using executive order, it becomes much more difficult. There's a lot of, okay, we'll give you this if you take away this, give you this. And what you end up with is a package that's probably less compellingly strong than what you would have got under a sweep kind of construct. Monetary policy is a little bit different. Now, monetary policy is and should be completely independent from the federal government. The monetary policy or policy authorities, those that make the decision on interest rates, really have a two mandate goal or a dual mandate goal. But the monetary policy authority, and when I'm saying monetary policy authority, guys, what I'm talking about is central banks. In Canada, it's the Bank of Canada. In the United States Federal Reserve Board. In Europe, it's the European Central Bank. And they're charged really with doing two things: maintaining full employment or an expanding economy at a regulated price level, meaning that inflation is supposed to be around 2%. And that's their dual mandate goal. And it's very simplistic if you think about it that way. Push for full employment and do it in a way that's not going to create an inflation spiral. So the monetary policy authorities had, really hit the market right as soon as COVID hit. Like if you think back to March, well, the federal government in the United States was trying to put together fiscal stimulus packages, negotiating. The Monetary Policy Authority, Powell, and the Federal Reserve Board put in some substantial liquidity measures and also dropped interest rates down to zero, right? So what I would say to you is that the president of the United States can have an impact on monetary policy in the construct that they appoint the governors and they appoint the next head of the Federal Reserve Board. But those appointments are sticky. They last for a long time. We're not going to see any change in who's on the Federal Reserve Board. I think there's a couple seats that are available, but Powell will remain the central bank governor. And if anything, I mean, he's provided Trump a pretty easy monetary policy path over the last couple of years, despite Trump complaining about him constantly through 17 and 18. So I don't think there's going to be a change in how the monetary policy authorities operate. But this is what I would say, and this is something I think that's key for everybody on the phone, is if you can't pass fiscal stimulus and you think about, and guys, I'm sorry if I get technical here, the last 10 or 15 years, it's the support for the economy has been all monetary policy. Okay, there's been very low budget deficits have shrunk, taxation has shrunk. The amount of revenue they're taking in, so the amount that they can spend has been lower. And it's really been left up to the monetary policy authorities to support the economy. And remember, they really only have two tools. The one tool is they can lower interest rates, and the second one is they can create currency reserves or print money, which is what they've done for the last 10 years. The problem is the effectiveness of that monetary policy has become less and less effective over time. If you guys think about a pendulum that swings like this, once it's swung once, it's starting to swing like this at the end. And now that we've got down to zero interest rates, it's the monetary policy authorities begging the federal government to come up with fiscal stimulus packages to create economic growth, because they haven't really created any growth. And, I'll just take a second. If you go back to the great financial crisis, which was 2008, and then the massive amount of programming that we had after that in Europe, in the United States, QE1, QE2, QE3, in addition to adhering to zero interest rates for a long period of time. European Central Bank, Japanese government, the Japanese Central Bank, all of them went with super easy monetary policy, the easiest monetary policy that I've seen in my 30-year career. At the start of it, the expectation was, oh my God, they're printing money like Germany did post-Second World War. We're going to be inflation in no time. But what I can tell everybody on the phone is 10 years later, the Fed is fighting a deflationary problem, not an inflationary problem. And that was evidenced in the last few weeks when the Fed went away from what they call their symmetric target to an average inflation target, meaning that they're happy to let inflation run very hot to try to create inflation expectations and get inflation back to a level that's consistent with economic growth, which is about 2%. What I'm saying, everybody, is that the effectiveness of monetary policy has run out at a time where we've had an election, and it looks like we're going to have a split between the president, Congress, and Senate, and difficulty in putting out a great fiscal stimulus package is going to put more pressure on the monetary policy authorities to stave off economic disaster. And one that we haven't even said it on this call. Let's not forget, COVID is still real. It's still raging through the United States, and there are a great deal of outcomes, based on who president is as it relates to management of COVID and what that means for the economy on a go-forward basis.
Yeah, we know Trump's stance on COVID, that's for sure. I think he's made it very clear. You did talk about inflation and employment rates. Now, inflation in Canada, I think most people, consumers, would say, well, the price of wood and the price of groceries and the price of all this stuff is going up. Yet, there's still lots of people that don't have jobs, and there's still lots of people that can't even get jobs for whatever reason. Now, what's this? I think it's called stagflation. Correct me if I'm wrong. Why don't you expand on that point?
Yeah, so stagflation's the absolute horror show for economies, and the term stagflation wasn't even around until the 1970s, and that's the first time it hit, when you had very, very slow growth, high unemployment, but you had high oil prices and inflation running super hot. So you think about the construct there is oh my God, our economy is expanding way below trend, but prices are going up. And constructively, prices go up when demand exceeds supply. Demand exceeding supply is usually consistent with strong economic growth. So, is there a risk of stagflation in the current environment? I'm going to say no, and it's because I got a very strong long-term view on inflation, and I'll explain it to you guys in a second. The stag part, absolutely. Unemployment in the United States is 8%. The major gains from return to work, I apologize, guys. The major gains from return to work have already been realized in the economy, and the reduction in the unemployment rate is going to be very, very slow. I'll also remind everybody that the unemployment rate in the United States got down to 3%, okay? And in the world of Keynesian economics, that's what we would consider something akin to full employment, meaning everybody who needs a job and wants a job has a job. There's always been some frictional unemployment. And what happens when your labor market gets to that level, i.e. the labor market gets tight, where the demand to employ exceeds the number of employees, you start to get upward pressure on wages, right?
Yep.
Well, in the last cycle, we got down to 3% unemployment, and there was no pressure on wages. And wages is the largest proponent of moving inflation higher. So in the environment we're in today, I can see the economy stagnating, but we're a million miles from full employment. Remember, the unemployment rate is at 8% in the United States, so there is no wage pressure. There's a huge output gap, the difference between how much an economy can produce and what it's actually producing, which is also disinflationary. And on top of that, you got a Fed that is trying to re-anchor inflation expectations. And I'm going to talk about inflation for a second once I get in and try to put it more into layman's terms. What I'm trying to say is the Fed is desirous of higher inflation. They're going to allow monetary policy to be very easy over a very long period of time. What that means to everybody on the phone is low interest rates for an incredibly long time. Now let's talk about inflation. And look, I get it. The price of cauliflower is $9 or whatever. You know, it feels like, especially in the city of Toronto, that like, you know, your housing's expensive. If you want to renovate, it's expensive. And these are all items that factor into an overall inflation level. But we also have to remember that over the last 30 years, we have created a massive amount of productivity and efficiency in our economies. You know, this is one I don't love talking about, but like, you know, when I started in this business, we used to be able to charge 2% to clients to manage a product. Okay, you know, 79 basis points or something. So there's a lot of your world has changed to become materially cheaper. Just think about walking into Best Buy and buying a 70-inch TV today. Like there's a ton in the economy that's going the other way due to technology and productivity gains, which has kept inflation low for a very long time. Hence why interest rates have been managed so low as well. The other thing I would say is that these are developed economies. The United States is not a new economy. And I'll say this to everybody, like I'm 53. I move a whole lot slower today than I did when I was 25. And what you're looking at today is, you know, this happened in Japan 30, 40 years ago, structural entitlements, lack of economic growth creates no inflation. It's been happening in Europe for the last 20 years and it's starting to happen. What we're witnessing is maturation of the developed world economy where the likelihood of spikes in inflation, given the differential between supply and demand of goods and services, is unlikely in the environment. So I don't see inflation as a large risk. For the clients that are on the phone, in the end, strong economic growth and inflation are the biggest risk to your bond portfolios. And I would say to you guys in this environment that neither of those are, you know, incredibly scary outcomes, especially after yesterday, where we're likely either going to be status quo with. Look, I think Biden's going to win. That's my personal opinion. I think that might be because I want Biden to win because I can't take another 4 years of.
We don't actually have an opinion on who wins, but this is my opinion.
Yeah, this is like, and listen, this is sitting here today at 11:30 while they're still counting votes, and I don't know if I'm giving you guys an opinion or I'm giving you guys my desire, but what I'm really trying to say is we're likely in a world where we don't have a sweep on either side, which means that all legislation slows down. The ability to change past stuff slows down. Like, for example, a Trump win with the Republicans holding Senate probably means 4 more years of generally market-friendly, economic policy. He's not gonna roll back his tax cuts. I don't know if he's going to continue to press on China. That could be, problematic going forward. I do know that he's unlikely to address COVID, which short-term probably means it's okay for the economy. Long-term probably means it's terrible because it will likely force a greater shutdown at some point in the future. Biden wins, he's going to push hard to try to increase spending on infrastructure, but he's going to have to get through that Republican Senate. So what I'm seeing right now is just, a lot more of this contestation, bipartisan politics ruling the day. And I don't know if there's a lot of, really strong economic outcomes that we can come to. And the last thing I would remind everybody as it relates to the economy and your thoughtfulness around investing is, COVID is the biggest problem right now. It's getting a handle on COVID, getting a vaccine distributed to a population to a point where there isn't restrictions on the mobility of your population. And I think we have to remember, even after the U.S. produced a 33.8% change in growth in the third quarter, that was preceded by a 31.8% decrease in growth in the second quarter and a 5% in the first quarter. We're still on a GDP basis producing in the neighborhood of the same GDP we produced over 2 years ago. So the U.S. economy has a long way to go to get back to where it was and does need this fiscal stimulus, which it's likely not going to see much of. So really, and I probably said this in too long a way, what I'm trying to say to everybody on the phone is cautious on risk markets. We think evaluations are very, very extended. I'm not trying to spook anybody, but just, be cautious. And on your fixed income side, Do not be afraid of interest rates, duration, or your price sensitivity of your portfolio being longer or being more exposed to long bonds, even though interest rates are very low, will help provide some counter correlation or opposite moves to volatility that we're likely to see in equities as we roll forward.
Thanks, Mark. That was an incredibly long answer. I'm sure
I apologize, guys.
It's okay. You like hearing your own voice, but you're really good at speaking, so it doesn't matter. If anyone has any questions, feel free to put them in that box there. I think it's really important that if you have something to ask that you should, and we've only get so much time with Mark. I wanted to just touch on interest rates. You did talk about it. Interest rates gone down for the last how many years? 15 years?
My entire career.
Your entire career, so that's much longer than my career for all the viewers out there. But probably not as long as Schick's career.
No.
No. So yeah, we're here in an environment. Interest rates are low. How long do you think the interest rates are going to stay low for? And then just touch on what this is actually going to do for Canada, and how Canadians should be really looking at this whole thing.
Okay. So, look, what moves interest rates, and I think most people on the phone understand that it's a concept of how the central bank views the very front end of the yield curve. So, just so we're all clear, central banks, when you hear Bank of Canada moved its rate or the Federal Reserve Board has changed its discount rate, that's where banks lend their excess reserves to each other on an overnight basis. That's not where you and I lend and you and I borrow. Governments borrow all the way out to 30, 40, 50, 60 years, okay? And those government rates are determined by market participants like myself who are trading them based on our forward-looking view of growth and inflation. So, bond comes out, and I'll give you guys an example. When I started in the business in 1991, the 30-year bond had a 9 3/4% coupon on it. Just so we're clear, that bond is going to mature next June. Okay. I've only seen interest rates go one way, and that's lower, and that's because bond market participants have seen a concerted change in inflation fundamentals over the last 30 years, where inflation has, on a core basis, meaning X of what we call food and energy, which is a volatile component, has trended below 2% for a very, very, very long time. And there's a lot of faith by market participants in the central bank's ability to execute monetary policy. You think about the last 30 years, okay, it's not that much of a mystery. We had the baby boom generation, which is the largest, most productive labor force in the history of mankind, coming in as technology was doing this. Yep. And we were able to produce a whole lot more widgets with a whole lot less people over the last, and that was really what took rates down to where they are. So the question is, as we approach zero in interest rates, which is essentially what we're doing, are we going to see a major change in the fundamentals on inflation that's going to create a mean reversion back to a higher rate structure? And what I'd say is possibly, but I don't think this is a concern anywhere in the next 2, 3, 4 years. I think it's going to take an awful long time for our economy to get back on what I would consider to be a normal trajectory. And just so we're clear, a normal trajectory pre the financial crisis was global growth at 4 and U.S. growth at 3. I think a normal trajectory now is global growth at 3 and U.S. growth at 2, and nominally inflation in the 1 to 2% area. So from my perspective, after seeing 10 years of substantially easy monetary policy, and just for everybody on the phone, the 4 large central banks had aggregate liquidity or aggregate currency reserves outstanding at the end of 2007 of about $4 trillion. That number was $21 trillion by the time all the QE happened in the United States and Europe and in Japan and People's Bank of China. So you think about a quadrupling of liquidity factors and zero interest rates for 10 years and that not creating inflation. I'm not certain today when we're at 8% unemployment where the inflation is going to come from. So, I see this boogeyman, and it's been a part of my career, my whole career, and everybody on the phone, including Schick and Sheehan, I'm just telling you, I haven't once walked into a meeting where I've been in front of an advisor and say, why would I buy a bond fund? Interest rates are going up, and I have heard that story from 9 down to 0. So when I sit here and I go, is it possible for a mean reversion? Could, a substantial fiscal stimulus package alongside, huge amounts of monetary policy, monetary currency reserve printing, create this inflation spiral? Yeah, it could. But I'll tell everybody on the phone, you are not paid to hedge inflation risk until you see the whites of the die, until it's slamming you over the head. So when I look at I'm telling you, I the million portfolio managers who've shortened duration over the last 10 years, the equity guys who continue to drill into trades that are reflation type trades that just never work out because the inflation never shows up. So I'm not certain what the type of circumstances we have today that are going to, create a change in the long-term trend on inflation. So my belief is rates continue to go lower. We likely see zero across the yield curve over the next 12 months. I think your bond funds can produce a pretty good rate of return in that environment and also provide a great deal of contra-correlation equity market volatility. The right bond funds, not all bond funds, but the right ones.
Yeah, there's a lot of bond funds out there for all those on the line. It's really interesting to know the differences between all of them. Some of them are pretty risky. It may as well be equities at some point, right? So again, if you need any advice on that, I'm between Mark, Schick, and myself, we can give you all the advice you need to figure out which are the good bond funds. So let's just finish off with one more question here. I know we're already over time, but I like talking to you. So
hey, listen, as long as everybody's still engaged, I'm happy. I'd stay here all day with you guys.
Last one. So, Canadians, whatever happens in the election, as a Canadian, what do we have to worry about?
Well, look, I suppose that a Biden win, is going to it will create some changes in terms of climate change and energy sector, constructs, and Canada is a big energy sector economy, but I don't know if we're going to see a material change in economic fundamentals based on either candidate winning. And especially given that the one thing I feel like I can really put my hand on is that we're not going to sweep red or sweep blue, which probably means more, more slow growth, more difficulty in passing legislation. I think Canada, our economy is a derivative of the U.S. economy. So, in a slowdown in U.S. economic fundamentals, there is a mirror effect in Canada as well. Now, our bank is also more conservative than the U.S. as well. I mean, we have actually higher overnight rate, even though the yields on our yield curve are lower. The Bank of Canada last week came out and said, look, we're worried about the borrowing rates for consumers and businesses, and suggested to market participants that, if they needed to, they'll buy 10, 30-year bonds to keep yields or risk-free rates low so that the borrowing rates that are based on those risk-free rates stay low. I suspect that with, middling economic growth, no inflation in the United States, that Canada is going to look a lot the same. We're going to be a derivative of that. I think you got to be careful with your equity investments because of the concentration in Canada. I think the S&P 500 probably is a more, global kind of construct in the U.S. is I think should be dominating more of your portfolios just to diversify your risk. And on the fixed income side, it's like you said, Shane, there's a lot of products out there, and there's core bond products which tend to have longer duration and little credit intensity or economic correlation, all the way out to, high yield funds, which have very little exposure to interest rates and a huge amount of exposure to the economy and tend to correlate. So it's really important for your investors to really understand what they own in their book and talk to you and talk to guys like us to understand, is this the kind of bond fund that's going to protect the downside if we believe that this is the outcome. So look, if I had to tell you guys anything, I think that rates probably continue to go lower. I think we're going to continue to see volatility in the stock market. I think the next month's going to be pretty interesting. I think we could see a lot of back and forth if Trump contests the outcome. I think the next couple of days are going to be interesting. It's like I said, I think predicting an outcome here is probably crazy. I think the only thing I feel reasonably confident about is the fact that we're not going to sweep one way or the other, and I think that creates a set of expectations, that are somewhat limited by the bipartisanship in U.S. politics.
Yeah, I totally agree. I think a lot of people, even though, they may not realize that there's like three different areas, president, Congress, Senate, and most people think that, the president gets the job, that's all that matters. And it's important to know that there are different people in different places, and having a mixed leadership is going to kind of, I don't know, you feel a little bit better about that, even if Trump wins it or
I mean,
Biden.
markets don't mind it because like, you don't get markets don't mind a mix, especially when it's a Democratic president. They like a sweep if it's Republican because you're going to get pro-business economic policy. And look, I suppose the Senate being there probably prevents Biden from rolling back some of the tax cuts and it'll probably but at the same time will limit the amount of fiscal stimulus that Biden can produce. I think Biden will do a good job of managing COVID, I think on a more national and appropriate basis. And I think that that's long-term better for the U.S. economy than trying to move towards some concept of herd immunity, which just sounds to me like a lot of people are going to die and there's going to be likely, tons and tons of rolling lockdowns.
Which is not going to be good, but yeah. Anyways, Mark, we have gone way over time. I'm sure people's time, time is valuable to people,
It
and I'm
certainly
sure they have
is.
to get back and eat their lunch or whatever. So thank you, everyone, for joining our call. Thank you, Mark, for being a part of this.
My pleasure.
If anyone needs anything, you've got my email, sheehan.patel@nbc.ca. You got Shik's email, shik.patel@nbc.ca, as well as our work number, 905-849-3549. Give us a call. We'll help you out. Hopefully enjoy the next week with whatever's going to happen in the election, and bye for now. We'll see you next week at 11:30. Ciao.